RSI tells you momentum, but it ignores something critical: how much money is actually moving. The money flow index fixes that by folding volume directly into the oscillator. Today, we dissect MFI, the math behind it, how to trade its signals, and where it quietly fails. If you already use RSI, this is the upgrade path worth understanding. MFI starts with the typical price: high plus low plus close divided by 3. Multiply that by volume and you get raw money flow. If today's typical price is up versus yesterday, it's positive flow. Down, it's negative flow. Sum each over 14 periods, take the ratio, and plug it into the same 100 minus 100 over 1 plus ratio formula RSI uses. Same chassis, but every tick is weighted by the dollars behind it. Think of price as the direction a crowd is moving and volume as how many people are in it. RSI just watches the direction. MFI watches the direction and counts the bodies. A handful of people drifting toward the exit means nothing. 10,000 surging that way is a stampede. MFI tells you whether a price move is a stampede or just a few stragglers, and that's the entire edge. MFI rides between 0 and 100. Above 80 is classically overbought, below 20 is oversold. Because volume amplifies the signal, MFI reaches extremes less often than RSI, so when it does, pay attention. Some traders prefer 90 and 10 for stricter filters in strong trends. The key insight: an extreme MFI reading means heavy volume is pushing price hard, and that pressure rarely sustains forever. This is where MFI really earns its keep. When price prints a higher high but MFI prints a lower high, the rally is happening on thinning dollar volume. That's bearish divergence, and because MFI is volume-weighted, the signal carries more weight than a plain RSI divergence. Bullish divergence works the same way in reverse. Lower price lows, higher MFI lows, meaning sellers are exhausting their ammunition. Here's the textbook setup on a synthetic chart. Price grinds to a new swing high. MFI peaks at 85 on the first push, then on the second price high, MFI only reaches 72. That's your bearish divergence. The trigger is when MFI crosses back below 80 while price stalls. Entry is on the close of that confirmation candle. The signal fails if price breaks above the divergent high on rising volume, so your invalidation is mechanical and tight. Now let's pressure test it on Apple daily candles over the last year. Watch for the spots where MFI pierces 80 during sharp rallies, then rolls over. Notice how the cleanest reversals happen when divergence builds across 2 or 3 weeks, not when MFI just taps overbought once. In trending names like this, single extreme readings get steamrolled. Confluence with prior resistance is what separates a tradable signal from noise. MFI fakes the famous failure swing. In an uptrend, MFI pushes above 80, pulls back but holds above 20, then breaks below its prior pullback low. That break is the failure swing sell signal. It often fires before classical divergence and gives an earlier exit. The bullish version mirrors it from the bottom. These are tighter, more mechanical signals than divergence and worth coding into alerts. MFI is not magic. It lags because it averages 14 periods. It whipsaws in choppy markets just like RSI. In a powerful trend, MFI can sit pinned above 80 for weeks while price keeps climbing, and shorting every overbought print will bleed you out. Low-volume stocks produce erratic readings because a single block trade distorts the typical price times volume input. Stick to liquid names. Combine MFI with a trend filter to avoid fighting strong moves. A 200-period moving average works. Only take MFI oversold longs above it, only take overbought shorts below it. Layer in support and resistance for entry zones, and use ATR for stop placement. MFI tells you the fuel gauge. The trend filter tells you the direction. Structure tells you the price. That trio is the practical workflow. First, do not use MFI on instruments without true volume data, like spot forks. The signal collapses. Second, do not blindly trust the 14-period default. Intraday traders often shorten it, swing traders sometimes extend it. Test before deploying. Third, never trade an extreme reading in isolation. Wait for the cross back through the threshold or for divergence to confirm. Patience converts a noisy oscillator into a real edge. Tomorrow, do this. Add MFI 14 to 3 liquid names you already watch. Mark every cross above 80 and below 20 for the last 6 months. Note which ones aligned with divergence and which got steamrolled by trend. That single exercise will calibrate your eye faster than any backtest. MFI is RSI with receipts. Use it where volume actually means something. This is education, not financial advice. Trade your own plan. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.